Let's be real for a second. The national portion of the real estate exam can feel manageable until the math questions show up. Suddenly, it's percentages, prorations, commissions, and the clock is ticking. That's exactly why I put together these 30 math practice questions. They're carefully selected to help you pass. Stick with me till the end. This practice can be a real game changer. Let's get started.
LexaWise Real Estate Exam Prep.
Let's see the first one. An office was sold for $26,750, representing a 7% increase in value from its original cost. What was the initial cost of the office? A. $24,877.50. B. $28,622.50. C. $24,750. D. $25,000. Take your time. The correct answer is D, $25,000. When a price goes up by a percentage, use this formula. Original price equals final price divided by 1 plus percentage increase. Now plug in the numbers. $26,750 divided by 1.07 equals $25,000. Let's keep going with the next question. The owner of a 4-unit apartment building pays a property manager an annual salary equivalent to 8% of the property's yearly gross income. If the gross income is $125,000 and the annual expenses are $25,000, what is the property manager's yearly salary? A. $12,000. B. $7,500. C. $8,000. D. $10,000. Think about it. The correct answer is D, $10,000. Here's why. Property manager's annual salary equals annual gross income times salary percentage. Property manager's annual salary equals $125,000 times 8% or 0.08 as a decimal. Property manager's annual salary equals $10,000. The gross income represents the total amount of money earned by an individual or a business before any deductions, such as taxes or expenses. Therefore, the property manager's salary is not related to the annual expenses in any way. Next question coming up. What is the minimum amount by which the value of Anthony's home needs to appreciate in order to compensate for the 9.5% cost of selling if he originally bought the home for $175,000 and wishes to sell it at a price that would allow him to avoid taking a loss? A. $20,750.55. B. $18,530.99. C. $193,370.43. D. $18,370.17. Take a moment to think. The correct answer is D, $18,370.17. Anthony paid $175,000. When he sells, he'll lose 9.5% of the selling price to selling costs. So he needs a selling price high enough that what he keeps after costs still equals $175,000. The amount he keeps is selling price times 1 minus 0.095. That's selling price times 0.905. Let selling price be P. Set that equal to what he needs to break even. 0.905p equals 175,000. Solve for p equals 175,000 divided by 0.905 equals 193,370.17. Appreciation needed 193,370.17 minus 175,000 equals 18,370.17. Quick tip, when you see X% cost of selling, divide the original price by 1 minus X% to find the break-even sale price. Next up, what would be the amount a grantor needs to pay for a $75,000 sale, considering transfer taxes are charged at a rate of 50 cents per $500? A. $75. B. $7.50. C. $750. D. $7,500. Take a moment. The correct answer is A, $75. All right, let's break it down step by step. The home sold for $75,000 and the transfer tax is 50 cents for every $500 of the sale price. Step 1. Find how many $500 chunks are in $75,000. $75,000 divided by $500 equals 150. Step 2. Multiply by the tax rate. 150 times 50 cents equals $75. The grantor would need to pay $75 for the transfer taxes on the $75,000 sale. Remember, when you see X cents per Y dollars, always divide the price by Y dollars first, then multiply by the cents amount. Let's move on to the next one. A property owner purchased a lot with dimensions of 400 feet by 1,200 feet. They paid $30 for each foot along the front. What was the total cost of the lot? A, $30,000. B, $12,000. C, $36,000. D, $1,200,000. Think it through. The correct answer is B, $12,000. To calculate the total cost of the lot, you need to multiply the front width, 400 feet, by the cost per foot, $30. Total cost equals front width times cost per foot. Total cost equals 400 feet times $30. Total cost equals $12,000. The total cost of the lot is $12,000. Next one. Ready? If a property is assessed for tax purposes at $142,000 and the tax rate applied is $1.98 for every $100 of valuation, what would be the amount of the monthly property tax? A, $250. B, $280.83. C, $2,808.36. D, $234.30. Got your answer? Well, you're on point if you said D, $234.30. Let's see why. Annual property tax equals assessed value divided by 100 times tax rate. Annual property tax equals $142,000 divided by 100 times $1.98 equals $2,811.06. Monthly property tax equals annual property tax divided by 12. Monthly property tax equals $2,811.60 divided by 12 equals $234.30. And here comes the next one in this round. If a property owner sold their property for $360,000, making an 8% profit, how much did they pay for that property when they bought it? A, $350,213. B, $333,333. C, $320,000. D, $340,876. What do you think? Well, the correct answer is B, $333,333. Let's break this down step by step. Step 1, define the relationship. Selling price, SP, equals $360,000. Profit percentage equals 8%. And we don't know the cost price, CP. We know selling price equals cost price plus profit percent times cost price. Selling price equals cost price times 1 plus profit percent divided by 100. Step 2, plug in the numbers. 360,000 equals CP times 1 plus 0.08. 360,000 equals CP times 1.08. Step 3, solve for cost price. CP equals 360,000 divided by 1.08. CP equals 333,333.33. So the property owner originally paid about $333,333.33 for the property. Let's keep practicing. Here comes another tricky math-based question. What is the value of a rental property with a 9% capitalization rate, given that it has an annual gross income of $79,000, a normal vacancy factor of 4.5% for the area, and annual building expenses of $4,300? A. $877,800. B. $790,500. C. $813,361.11. D. $950,000. Take a moment to think. The correct answer is B. $790,500. Let's walk through this slowly, step by step. Here, we've been asked to find the value of a rental property using a capitalization rate. So the key formula is value equals net operating income, NOI, divided by cap rate. Step 1. Account for vacancy. The property earns $79,000 per year, but we must subtract vacancy. Vacancy loss. $79,000 times 4.5% equals $3,555. Effective income. $79,000 minus $3,555 equals $75,445. Step 2. Subtract annual expenses. $75,445 minus $4,300 equals $71,145. NOI. Step 3. Apply the cap rate $71,145 divided by 0.09 equals $790,500. Quick exam trick. To find value, always find NOI first, income minus vacancy minus expenses, then divide by the cap rate. Next question. What is the formula for calculating the commission earned by a real estate agent on a property sale? A. Property price times commission percentage. B. Property price divided by commission percentage. C. Commission percentage divided by property price. D. Commission percentage plus property price. Think for a second. The correct answer is A. Property price times commission percentage. The formula for calculating the commission earned by a real estate agent on a property sale is property price times commission percentage, where the commission percentage is typically agreed upon in advance between the agent and the seller. Let's go to the next one. What is the formula for calculating the loan-to-value ratio of a property? A. Loan amount divided by property value. B. Property value divided by loan amount. C. Loan amount times property value. D. Property value minus loan amount. The correct answer is A. Loan amount divided by property value. The formula for calculating the loan-to-value ratio of a property is loan amount divided by property value, which represents the amount of the loan relative to the value of the property. Now let's test your understanding with this one. John is a real estate agent who is working with a buyer to purchase a property for $200,000. If John's commission rate is 5%, how much commission will he earn on the sale? A. $10,000. B. $5,000. C. $8,000. D. $15,000. Pause for a moment to consider it. The correct answer is A. $10,000. To calculate the commission, you simply multiply the sale price by the commission rate. Commission equals sale price times commission rate. $200,000 times 0.05 equals $10,000. Let's keep it rolling. Mark is a real estate investor who is considering purchasing a property for $300,000 with an expected annual net operating income of $30,000. What is the capitalization rate of the property? A. 0.08 or 8%. B. 0.10 or 10%. C. 0.12 or 12%. D. 0.15 or 15%. Take your time. The correct answer is B. 0.10 or 10%. The explanation is simple. The capitalization rate of the property is calculated by dividing the expected net operating income, $130,000 by the property value $300,000, which equals 0.10 or 10%. Here comes another one. Jenny is a homeowner who has a mortgage balance of $215,000 on a property that is currently valued at $345,000. What is the equity in her property? A. $130,000. B. $145,000. C. $345,000. D. $560,000. Think about it. The correct answer is A. $130,000. The equity in Jenny's property is calculated by subtracting the mortgage balance, $215,000, from the current property value, $345,000, which equals $130,000. Let's look at a tax-related question now. What is the annual property tax bill for a property assessed at a value of $300,000, assuming a tax rate of 2.7%? A. $4,900. B. $8,100. C. $2,500. D. $5,000. Don't rush. Think it through. The correct answer is B. $8,100. Here's how it works. Property value equals $300,000. Tax rate equals 2.7%, 0.027 as decimal. Annual property tax bill equals $300,000 times 0.027 equals $8,100. All right, here's one more for this round. What is the total square footage of a rectangular property that measures 40 feet in width and 80 feet in length and has a large oak tree in the middle of the yard? A. 2,400 square feet. B. 3,200 square feet. C. 4,000 square feet. D. 5,000 square feet. Let's pause and think about this one. The correct answer is B. 3,200 square feet. The formula to calculate the total square footage is simple. You must multiply the width by the length. In this case, 40 times 80 equals 3,200 square feet. This is the total size of the property in square feet. Let's move on to the next one. What will be the total amount of quarterly property tax bill for a property that has an assessed value of $300,000 and is located on a street named after a famous historical figure? The tax rate for the property is 1.5%, and it is situated in a neighborhood with a high walkability score. A. $3,750. B. $1,125. C. $750. D. $375. Let's crunch the numbers. What do you get? The correct answer is B. $1,125. If the property's assessed value is $300,000 and the tax rate is 1.5%, first we have to find the annual property tax. $300,000 times 0.015 equals $4,500 per year. Now, because the question asks for the quarterly tax bill, divide by 4, $4,500 divided by 4 equals $1,125. And that's the property's total amount of quarterly property tax bill. Next question. A buyer is interested in purchasing a property for $400,000 and has saved up a down payment of 20%. If the buyer has an additional $50,000 invested in the stock market, how much money will they still need to borrow to complete the purchase? A. $240,000. B. $320,000. C. $300,000. D. $480,000. Take a few seconds to run the numbers. The correct answer is B. $320,000. To find the amount of money the buyer will need to borrow, you would subtract the down payment from the purchase price. In this case, 20% of $400,000 is $80,000. So $400,000 minus $80,000 equals $320,000. That's the amount of money that the buyer will need to borrow to purchase the property. The additional $50,000 invested in the stock market is not considered part of the down payment. Let's keep going. If a property is appraised at $400,000 and the bank requires an 80% loan to value ratio, how much is the maximum loan amount the bank will provide? A, $80,000, B, $240,000, C, $320,000, D, $400,000. Work it out and see what you get. The correct answer is C, $320,000. To calculate the maximum loan amount, you can multiply the appraised value by the loan to value ratio as a decimal. In this case, 80% as a decimal is 0.80. So the maximum loan amount would be $400,000 times 0.8 equals $320,000. Let's move to another one. If a commercial property sells for $600,000 and the buyer puts down a 25% down payment, how much money does the buyer need to put down for the down payment? Assuming the buyer is interested in a 15-year fixed rate mortgage with an interest rate of 4.5% and no discount points. A, $25,000. B, $75,000. C, $150,000. D, $450,000. Pause and calculate the answer carefully. The correct answer is C, $150,000. In this case, 25% as a decimal is 0.25. So the down payment would be down payment equals 0.25 times $600,000. Down payment equals $150,000. Therefore, the buyer needs to put down $150,000 for the down payment. Remember, discount points, when they exist, equal 1% of the loan. Let's see what's next. A married couple is interested in purchasing a beachfront property for $350,000. They are able to negotiate a 20% down payment and are interested in obtaining a 30-year fixed rate mortgage with an interest rate of 4% and a loan origination fee of 1.5% of the mortgage amount. How much money will they need to pay for the loan origination fee? A, $3,500. B, $4,000. C, $4,200. D, $5,250. Give it a moment. Let's see if you're right. The correct answer is C, $4,200. If the home costs $350,000 and the buyers are putting 20% down, that means they're borrowing 80% of the price. First, we need to find the loan amount. $350,000 times 0.80 equals $280,000. Then, we're going to calculate the loan origination fee. The fee is 1.5% of the loan amount. $280,000 times 0.015 equals $4,200. Here's another one. What adjustments need to be made to the sold price of a $270,000 comparable property with a pool, $15,000, considering the subject property has an additional bedroom, $5,000, and bathroom, $6,000? A. The adjusted value would be $266,000. B. The adjusted value would be $244,000. C. The adjusted value would be $296,000. D. The adjusted value would be $274,000. Take a second to process. The correct answer is A. The adjusted value would be $266,000. Let's simplify this and think like the exam wants you to think. You always adjust the comparable, not the subject property. The comparable sold for $270,000 and it has a pool worth of $15,000. The subject property does not have a pool, so we subtract $15,000. $270,000 minus $15,000 equals $255,000. The subject property does have an extra bedroom, $5,000, and bathroom, $6,000. So we add $11,000. $255,000 plus $11,000 equals $266,000. So the value would be adjusted to $266,000. Let's continue with the next one. How many points should a lender charge on a $250,000 loan with a 5.5% interest rate and a 30-year term to achieve a 5.75% yield? And what would be the cost for the borrower? A. 2 points, and the borrower must pay $5,000 for those points. B. 2 points, and the borrower must pay $2,500 for those points. C. 4 points, and the borrower must pay $5,000 for those points. D. 1 point, and the borrower must pay $2,500 for those points. Ready? Here's what it is. The correct answer is A. 2 points, and the borrower must pay $5,000 for those points. Let's take it one step at a time. The lender wants a 5.75% yield, but the loan rate is 5.5%. That's a difference of 0.25%. Step 1. Find how many points are needed. Each point raises the lender's yield by 0.125%, so 0.25% divided by 0.125% equals 2 points. Step 2. Find the cost of the points. 1 point equals 1% of the loan amount. Therefore, 1% of $250,000 equals $2,500 per point. 2 points times $2,500 equals $5,000. Don't forget that points increase yield, and each point always equals 1% of the loan amount. All right, here's the next one. Get your calculator ready. Alice obtained a 15-year, $150,000 amortized loan, 6.5% interest rate, and a $1,306.66 monthly payment. What is the principal paid in the second month? A. $809.82. B. $499.52. C. $494.16. D. $496.84. The correct answer is D. $496.84. Let's break it down. First, calculate the interest paid in the first month. Interest rate per month equals annual rate. Divided by 12 equals 6.5%. Divided by 12 equals 0.54%. That's 0.005416 as a decimal. Interest for month 1 equals $150,000 times 0.005416 equals $812.50. Now we subtract that from the monthly payment. $1,306.66 minus $812.50 equals $494.16. This is the principal paid in the first month. Remaining balance after month 1 equals $150,000 minus $494.16 equals $149,505.84. Now for the second month, interest equals $149,505.84 times 0.005416 equals $809.82. Principal equals $1,306.66 minus $809.82 equals $496.84. Let's move on to the next question. This one's about affordability. Think you can estimate it? Luke earns $45,000 per year, and the lender uses a 31% income ratio for the PI payment. What monthly PI payment can Luke afford? A. $1,290.32. B. $1,162.50. C. $1,451.61. D. $3,750. Time to think it over. The correct answer is B. $1,162.50. Here's how it's calculated. First, we get Luke's monthly income. $45,000 divided by 12 equals $3,750. After that, we multiply by the lender's ratio. $3,750 times 0.31 equals $1,162.50. That's how much Luke can afford in principal and interest every month. Ready for the next one? Let's go. The Miles have two potential loan offers for their $89,000 home equity application. The first is an interest only loan at 5.75% for 7 years with 0 points, and the second is a similar loan with an interest rate of 5.20% for 7 years, but with 2 points due at closing. Which of the two loans will result in a lower total interest payment for the Miles? And what is the difference in cost between the two? A. The first option by $1,780. B. The second option by $1,646.50. C. Both options charge the same amount of interest. D. The second option by $3,426.50. Pause and take your time to reflect. The correct answer is B, the second option, by $1,646.50. Here's how we get that. First loan, annual interest equals $89,000 times 5.75% equals $5,117.50 over 7 years equals $5,117.50 times 7 equals $35,822.50. Second loan, 2 points equals 2% of $89,000 equals $1,780. Annual interest equals $89,000 times 5.20% equals $4,628. Over 7 years equals $4,628 times 7 equals $32,396. Total cost with points equals $32,396 plus $1,780 equals $34,176. Now compare $35,822.50 first loan minus $34,176. Second loan equals $1,646.50. So the second option saves the Miles $1,646.50 in total interest. Let's move on to the next one. If a broker received a commission of $11,400 on a property sale and was paid 6% on the first $150,000 and 5% on everything above that, what was the sale price? A. $210,000. B. $285,000. C. $198,000. D. $190,000. Take a second to run the numbers. The correct answer is C, $198,000. Let's simplify this into individual steps. The broker earned a total commission of $11,400. We're told the commission is 6% on the first $150,000 and 5% on anything above that. Step 1. Calculate commission on the first $150,000. 6% of $150,000 equals $9,000. Step 2. Find how much commission is left. $11,400 minus $9,000 equals $2,400. That $2,400 came from the 5% portion. Step 3, convert commission back into sale price. $2,400 divided by 0.05 equals $48,000. Step 4, add it back to the first $150,000. $150,000 plus $48,000 equals $198,000. That's the original sale price. Using the straight line method, the improvements have already been depreciated by 33.5%. If the remaining economic life is projected at 13 years, what is the implied annual rate of depreciation going forward? A. Value of the building is $140,000. B. The data given is not enough to determine the rate of depreciation. C. Rate of depreciation exceeds 5% per annum. D. Time of depreciation to date is over 12 years. Give this one a second. If you said that the rate depreciation exceeds 5% per annum, you're correct. In order to know that, you need to do this. 100% minus 33.5% equals 66.5% remaining to depreciate. 66.5% divided by 13 years equals 5.11% per year. Let's tackle this one now. What is the reciprocal of 4%? A. 25.0, B. 2.5, C. 0.25, D. 250.0. What do you think of this one? Well, in this case, the correct answer is A, 25.0. The reciprocal of a number is simply 1 divided by that number. The reciprocal of 4%, which can also be expressed as 0.04 in decimal form, is reciprocal equals 1 divided by 0.04 equals 25. This is important because on the exam, percentages like 4% usually represent a rate, most commonly a capitalization rate or a rate of return. When you're given income and asked to find value, you don't multiply by the rate. You divide by it, which is the same as multiplying by its reciprocal. Next question. This one involves government land descriptions. What is the total area in acres in the government rectangular survey in the southeastern quarter of the western quarter of the eastern half of section 21? A. 80 acres. B. 20 acres. C. 10 acres. D. 40 acres. Take a second. The correct answer is B, 20 acres. A typical section of land consists of 640 acres, so the eastern half would have 640 divided by 2 equals 320 acres. Next, we need to find the western quarter of the 320 acres calculated earlier. This would be 320 divided by 4 equals 80 acres. Finally, we need to determine the southeastern quarter of the 80-acre area. This would be 80 divided by 4 equals 20 acres. Let's keep going. This is the last one, so it's a bit more complex. Harris sought to buy a 3-story apartment building for a 12% investment return. With 2 apartments per floor, first floor rent was $1,200, decreasing by $100 per floor. Factoring in a 17% rent loss and $350 monthly operating expenses, Harris calculated the maximum he would pay for the building was A. $516,650, B. $116,200, C. $660,000, D. $512,800. If you said D, $512,800, then you are really on point. Here's the reasoning behind it. First floor, 2 apartments at $1,200 each equals $1,200 times 2 equals $2,400. Second floor, 2 apartments at $1,100 each equals $1,100 times 2 equals $2,200. Third floor, 2 apartments at $1,000 each equals $1,000 times 2 equals $2,000. Total rent collected per month equals $2,400 plus $2,200 plus $2,000 equals $6,600. Loss of rent equals $6,600 times 0.17 equals $1,122. Effective rent collected per month equals $6,600 minus $1,122 equals $5,478. NOI equals $5,478 minus $350 equals $5,128 per month. Annual NOI equals $5,128 times 12 equals $61,536. Maximum price equals annual NOI divided by desired return rate. Maximum price equals $61,536 divided by 0.12 equals $512,800. That's it for today. Great work sticking with me through all 30 of those real estate math practice questions. Every time you work through problems like these, you're building the skills and confidence you'll need to handle the math portion of the National Real Estate exam with ease. If you found this practice helpful, check out our other real estate exam videos and visit lexawise.com for even more resources, guides, and practice tests to help you pass your exam. You'll find the link in the description below.